In this video we are going to talk about the waste management stock. So before starting this video, please like this video and subscribe to our channel for future updates. Waste Management, NYSE, WM, is in charge of the unglamorous task of garbage collection. It's one of those things that must be done no matter what is going on in the world or on Wall Street. However, this information alone isn't enough to convince you to buy a stock. Is this going to be a blockbuster deal? Advanced Disposal's $1.8 billion debt is included in Waste Management's imminent $4.6 billion acquisition of Advanced Disposal. Furthermore, Waste Management aims to finance the transaction using debt. Isn't that concerning? It isn't always the case. First, given its good credit rating and liquidity, Waste Management should have no trouble obtaining low-cost financing. Second, as its 12-month interest coverage ratio of 5.43 demonstrates, its operational revenue currently covers its interest expenses well. In other words, a small bit of new debt should not be detrimental to the organization. What matters is what Waste Management gets in return, the fourth largest waste management firm in the US. That's not a bad deal, and it looks much better once you learn the following crucial facts regarding Advanced Disposal. Advanced Disposal has locations in 16 states throughout the Midwest, South, and East. It serves 2.7 million household users as well as over 200,000 industrial and commercial clients. It owns or operates 41 landfills, each with a life expectancy of about 37 years. There are 18 landfill gas-to-energy conversion facilities on the property. Natural gas is used in 20% of the fleet. In 2020, it brought in $1.9 billion in revenue. As a result, Waste Management's acquisition of Advanced Disposal should broaden its reach, asset base, and green fleet, further strengthening its leadership position in the market. There's a lot of potential to be unlocked in the long run, especially because management expects the purchase to be immediately accretive to adjusted earnings per share and cash flow from operations. So, is it a good time to buy Waste Management stock? The deal has been in the works for more than a year, which is one of the reasons Waste Management stock soared to new highs in March before collapsing along with the rest of the market. So you might want to wait for a price drop before buying Waste Management stock, but don't wait too long. It's a safe, dependable stock with a dividend. Its dividend has been increasing for 17 years in a row, and it now yields 1.9%. A question of value. There's no doubt that Waste Management is a great firm that has been consistently developing, and that its management team, led by CEO Jim Fish, is doing an excellent job. The company's share price, on the other hand, has outpaced its earnings growth, implying that it is trading at all-time high values. Republic Services, incidentally, is in the same boat. Throughout much of 2020, Waste Management's price-to-earnings ratio climbed steadily, from 16 to 20, to 24, to 28, and finally to 28. It's currently at 29.6, which isn't quite an all-time high but certainly in the upper echelon. Other value measures reveal a similar picture. The company's price-to-free cash flow ratio of 29.2 is the highest since 2000. Its enterprise value to EBITDA ratio of 14.8 is less than a tenth of a point below its 2000 peak. Meanwhile, despite increasing its dividend every year for the past 17 years, the company has been unable to keep up with the rise in the stock price. As a result, the dividend yield has dropped from almost 4% in 2013 to only 1.7% now. Is it, however, a good buy? Not a bargain but a buy. When reviewing the company, I've said that if the P/E ratio rose beyond 30, I'd have to think long and hard about whether to buy. It's crucial to note, though, that once the Advanced Disposal deal complete, Waste Management's profitability and cash flow should instantly improve. That suggests the present valuation measures could be inflated, but we won't know for sure until the sale is completed. Even if the stats are correct, Waste Management appears to be a long-term investment. Even at its current price, its inherent scale advantages, combined with an outstanding track record of outperformance and reasonable prospects for ongoing expansion, should pay out for investors. Dividend investors seeking high returns, on the other hand, should definitely look elsewhere. Here are 4 things to think about before boarding Waste Management. Waste Management is a highly reliable business. The coronavirus epidemic made 2020 a terrible year for many businesses, but Waste Management's business performed admirably. Given the health challenges, that's a really good showing. However, revenue and adjusted EBITDA both increased marginally year-over-year in the fourth quarter, rising 5.4% and 1.8%, respectively. As 2020 progressed, the findings improved. To be honest, earnings in the fourth quarter and for the year as a whole were lower, but Waste Management's business remained solid. This is to be expected, considering that it gathers waste, which is something that must be done regardless of the world's problems. In terms of the year-over-year profits declines, it's important noting that during the early stages of the epidemic, the company granted pricing reductions to selected clients, purposefully hurting its bottom line to support key partners. Overall, given the circumstances, 2020 was a good year for Waste Management, demonstrating the company's resiliency. Waste Management has irreplaceable assets. The size of Waste Management's business is something that should not be disregarded. It is a $15 billion firm with a customer base of 20 million people. A vast fleet of vehicles and facilities, including 244 solid waste landfills and 5 hazardous waste landfills, underpins this. A garbage truck or an industrial site can be purchased by almost anyone, but a landfill is a different issue. Landfills are heavily regulated assets, and few people want a new one developed in their neighborhood. Having landfills gives Waste Management a place to dump the rubbish it collects, as well as the ability to tax rivals who deposit their waste in these facilities. It's a long-lasting competitive edge. Waste Management is increasing shareholder value. Waste Management has increased its dividend for 17 years in a row, with another rise planned for 2020. This demonstrates a significant commitment to shareholders and should pique the curiosity of dividend investors. Meanwhile, the average annualized dividend rise over the last decade has been around 5.5%. In general, Waste Management is a consistent performer with a diverse and resilient business. So far, everything has gone well. There is a minor issue with Waste Management. However, the question here isn't whether Waste Management is a good firm. A good firm might become a disastrous investment if you pay too much for it. This is the source of the issue. Waste Management's current dividend yield is a meager 1.9%, which can be utilized as a simple value indicator. That's more than the 1.5% or so that an S&P 500 index fund would provide, but it's not a tremendous number in absolute terms. Waste Management is unlikely to appeal to anyone trying to increase their present income. This means that the stock is now overvalued. Waste Management's price to sales, price to earnings, price to cash flow, and price to book value ratios are all above their 5-year norms, confirming this conclusion. As previously stated, this is a slow and steady turtle of a firm, not a fast-growing technology stock, thus growth investors should avoid it as well. What are your thoughts on our video? Please let us know in the comment section below. If you enjoyed this video and would like to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.